Alright, for this video I want to go over the IRS Form 5227 for a split interest trust, and specifically what we're going to look at here is a charitable remainder unit trust, and we're going to look at a net income charitable remainder unit trust. So I've done a previous video on just your standard CRUT, so your standard charitable remainder unit trust. So if you want to have a look at that one first and then come back to this one. And the reason being, the net income element makes it a little more complicated, right? So within the CRUT kind of family, we have net income CRUTs, net income CRUTs with makeup provisions, flip CRTs, things like this. So if you want to first look at just what is a kind of standard charitable remainder unit trust, I'll put a link to that video below. So we're going to go over the full 5227 I've got in front of us. I do have a sample consolidated 1099 from our brokerage company, which shows the dividend, income, interest, capital gains. And then we do have an Excel workbook here where I put together kind of some basic financial statements for the trust and some income reconciliation tabs. And so we'll go through all this as well. And then lastly, just some two slides, this one covering some more detailed rules on the net income CRUT and what you need to be mindful of. And then this first one, which we'll start with, is just some background on charitable remainder trust and then details on the fact pattern itself. So within the charitable remainder trust family, we have annuity trusts and then Unitrust. The annuity trust is effectively a fixed dollar amount that is paid to that income beneficiary each year, regardless of how much income the trust makes or whether the values of the assets go up or down. The income beneficiary effectively gets the same dollar amount every year. Now with the unit trust payment, the payment to the beneficiary is a percentage of the fair market value of those assets as they go up and down, right? So the amount kind of fluctuates. And then within the unit trust family, we have net income CRUTs with makeup provisions, flips. And for this video, we're focusing on the first one, which is a net income charitable remainder unit trust. Now, with the net income element, that changes things here. When you have a standard CRUT, the payment, that percentage, it doesn't change every year, and it's paid out even if the trust has no income to be able to pay it. So what will often happen is the trustee has to pay principal out of the trust to that income beneficiary. The net income provision effectively prevents that from happening. So when you have a net income CRUT, the trustee pays the lesser of the trust accounting income or that percentage of the fair market value of the assets. And so that's what we're going to see here with our example, is we're going to have a net income CRUT where the unit trust payment percentage is more than the trust actually made in income. So the income beneficiary is getting the lower amount of the two. All right, so let's look at our example. We have John Smith. He sets up this net income CRUT by putting in $1 million in cash. And the trust agreement says that the trust shall pay a unit trust amount equal to the lesser of 6% of the net FMV of the trust assets as of the first day of each year, or the trust income for the taxable year as defined under the tax code. The unit trust period shall be for a period of 10 years. The amount shall be paid in one installment each year at the end of the calendar year. So this non-charitable income beneficiary is going to be John's son, Adam Smith, and then the remainder interest is going to Medical Charity Inc., which is a Florida-based, not a real charity obviously, but let's say this is a Florida-based tax-exempt 501c3 organization. Now that $1 million is invested into publicly traded stocks and bonds, and during the first year, the total unit trust amount payment that could go to Adam is this first computation, $54,904, which is a prorated amount of the $60K. So 6% times $1 million at the start of the year, prorated for the short year, is $54,904. So this could be the amount that Adam gets. But remember, the amount that the income beneficiary gets is the lesser of these two values. So it's the lesser of 54,904, or what is the trust accounting income for the year. And that's what we'll look at. We don't know it now, right? When the year is started, we have no idea what the trust accounting income is going to be for the period. So the trust had some trustee fees, legal fees, accounting fees, so we'll account for those. And the trust agreement does stipulate that capital gains should be allocated to principal. The trustee is not permitted to reallocate those to income. All right, so here are some of the main kind of tax and trust accounting income considerations that we need to be mindful of for these net income CRUTs. All right, the first one is, as I highlighted on the previous slide, right, the net income CRUT prevents, for the most part, the trustee from dipping into principal to pay that non-charitable income beneficiary, right? And that's because we have this cap, right? It's the lesser of the trust accounting income or that percentage Unitrust amount. Now, trust income generally means income as defined under the tax code, and so you look to the terms of the trust agreement and then applicable state and local laws. Now, again, the capital gains normally not allocated income. They are allocated to trust corpus, but the agreement can change that, right? The agreement can provide that a trustee can allocate capital gains to income. Obviously, there's a lot of rules and exceptions, and one such big one for these net income CRUTs is pre-contribution appreciation of assets. So in our example, John just put in cash, but what if he put in property that his basis was much lower than the fair market value? So there's this built-in gain already. If that happens and the asset is sold, the capital gain to the extent of that FMV on the date of contribution has to be allocated to principal. You cannot reallocate that to income. Not going to happen here for our example because we don't have any of that. He just put in cash, so we don't have any pre-contribution gains. So very, very important kind of teaching point here is, follow the trust agreement. This has happened many a times where trustees are incorrectly adding capital gains to income, or they're just overall just calculating trust accounting income wrong. And so it results in a income distribution, so a Unitrust payment to a beneficiary that is not correct. It's either overstated, understated. And so the IRS can step in and say, well, we don't think this was ever a charitable remainder trust because you've just been doing it wrong from day one. So you have self-dealing excise tax issues, then it's just a disaster, right? So carefully review the agreement, make sure that everything is being done as was laid out by the terms of the trust. Now, some Unitrust payment and self-dealing issues here. The big ones, as I've touched on, are when to make the payments and how to calculate them. So payments after end of the year, right? So this bullet point here, net income CRUTs will not know the trust accounting income at the start of the year, right? But you have to still distribute the lesser of these two amounts. And so the Treasury regs have carved out these kind of issues, right? And they have provided us some relief here. So the first one is, can we make the payment after the end of the year? And the answer is yes, right? So if the trust has this income exception, right? So that's the net income exception. It is not going to be an act of self-dealing, doesn't create any unrelated debt financing income, or fail to jeopardize its status as a charitable remainder trust if the payment of the Unitrust amount is made within a reasonable time after the close of the year. And it also goes on to say that, well, reasonable time, what does that mean? It means that it's not going to be beyond the date the trustee has to file the return. So what happens in practice is you kind of do the return, figure out what the Unitrust amount is, and then the trustee pays it, and then you go ahead and file. Right? That's really kind of how it works. And so as long as it's filed, as long as the payment is made before you file the return, then you should be good to go. Now, the other big question is, well, what's the year of inclusion? Right? And from the income beneficiary's perspective, they're thinking, well, I'm a cash basis taxpayer. So if I don't get paid until after the end of the year, why is it I have to record it as if I did get it in the prior year? right? And so the year of inclusion under the regs simply says the annuity or Unitrust amount is includable in the recipient's gross income for the year in which the amount was required to be distributed, even though not distributed until after the close of the year. So makes it quite straightforward there, right? Calculated as if it was paid out before the end of the year, pay it out, and then give the income beneficiary K-1 that shows they got it. All right, shows they got it before the end of the year. All right, so let's have a look at the return, and we'll start looking at some of these Excel workbooks. So we've got the 5227 here. Basic information up top here on the trust. Obviously, the name of the trust EIN. Box C, we've indicated that it is a charitable remainder unitrust under Section 664D2. And then the contact information for the trustee. So trust company, name and address. The fair market value of the assets at the end of the year and the gross income earned during the year, very important. We are marking an initial year return and the date the trust was created. Now, page 1 is split up into a couple of sections. We separate the income into ordinary, capital gains, and non-taxable. That's very, very important for the ordering rules, right? There are special ordering rules for how we distribute income to those income beneficiaries, and so that's why we track them separately. And then in Section D, we have deductions, and in Section E, we allocate those deductions to the various income categories. So if we start with ordinary income, that's your interest, your dividends, business income, rents, royalties. And so on our 1099, and we'll have a look at the financials as well, we've got some dividend income here from the broker, interest. We've got some short-term capital gains that we need to account for. And so when we look at our profit and loss and balance sheet, we've got our interest on savings and checkings, bond interest income, dividends. Then we've got our various expenses there. And so we've also accounted for the same in our income reconciliation. So we'll go into these when we look at the deductions. I'll look at that a little more closely for us. So report everything in the appropriate category. So we have our interest up here, 8351, the dividend income, the qualified portion of those dividends. So remember, ordinary dividends is split up into non-qualified and qualified. So that's the total ordinary piece. That's the qualified portion. Capital gains and losses, we did include 8949, and we've included the Schedule D as was asked of us. And then ultimately, that net amount is reported here in Section B for capital gains or losses. Non-taxable income, we don't have any, right? So tax-exempt interest, that would be interest products on municipal bonds, right? That's a classic example, right? So state or local municipal bonds are non-taxable at the federal level. And then here we have our deductions. So all of our trustee fees or attorney and accounting fees, and the total fees was $8,500. Now, getting into Section E, allocating deductions. This is important because we are able to claim the deductions, and so the net amounts are going to be what's allocated out to the income beneficiaries. So how do we allocate our $8,500 to all these income types? It's done on a pro rata basis. So you first allocate expenses if you can specifically identify expense that is attributed to a certain type of income. Right, so if you can trace with a lot of specificity expenses that apply to one of these income types, then go ahead and specially allocate it to it. But in most cases, that's not going to happen, honestly. You're just going to be allocating them on a pro rata basis. So when we look at our workbook here, what I've done is I've listed the different types of income. So our interest, non-qualified dividend, qualified dividend, short-term capital gain. And then the deductions of $8,500 is allocated to each of these pro rata. So the total here, this is $8,500, right? 4,887 plus 3,613. And we're allocating the deductions based on the relative amount of the interest to the total. So just got a simple formula here where I allocate it in such a manner. And then so the net amount is obviously the gross total amount minus the deductions. And so we can see here that the net distributable amount, 34,476, that reconciles with what we see here on line 24B. So we've allocated 4,887 in expenses to ordinary. So our net amount distributable to the beneficiary potentially is 34,476, and do the same with capital gains. So the capital gain amount allocated is short term, 3,613 in expenses, 3,613, and then the net amount of capital gains available for distribution to income beneficiaries is 25,489, and then lines 26A and B, nothing, right? Because we didn't have any non-taxable income to even apply expenses to, right? All right, so we move on to page 2, parts 2 and 3. So schedule of distributable income. So section 664 trusts, these are charitable remainder trusts. If this is a lead trust, you wouldn't be completing this section. But in our case, we have to. So on line 1, undistributed income from prior years. We don't have any because this is a first year, right? So we didn't have any undistributed income from a prior year. And even if this is a return that has been filing multiple years, it's certainly possible that you might not have any undistributed income if you are distributing everything out to the income beneficiary. All right. Current year net income or loss before distributions. So column A, enter the amount from part 1, line 24B. So that's a reference to this section up here, right? So our net amounts are flowing down to part 2 here. Now, the difference in excluded income versus accumulated net investment income post 2012. So this is a reference to that net investment income tax, that 3.8% tax. What we're doing here is we're saying, well, to what extent are we realizing this income that is or is not subject to that NIT? If you have an older trust that is having income flow through pre the net investment income tax, then you can have excluded income. So you would have excluded income potentially in these columns. This trust was set up in 2022. All of this is NIT, so it's all accumulated NII post 2012. So that's why we're using these columns. So we've got their ordinary income, the capital gain income that is distributable or potentially distributable to that income beneficiary. Now, part 3, we haven't made any distributions of principal for charitable purposes, right? This is a remainder trust, so the payments going out to the income beneficiary are going to go to the income beneficiary alone for the most part, and then it's going to be that remainder interest that goes to the charitable group. Part 4, the balance sheet. Okay, so pretty straightforward here, but a couple of things to highlight. The beginning of year values, we don't have any entries because this is a first year. If you have a second year net income CRUT, then the beginning year book values will be the end of the year book values from the prior year return. Right, so very similar to a lot of other balance sheets presentations that we see on other types of filings. So the end of the year book values, we separately stated non-interest bearing cash and interest bearing cash and other kind of temporary investments. Investments in corporate stocks and bonds listed here. Right, so on our balance sheet, what we've done is we've separated out our assets, right, investments in publicly traded stock, corporate bonds, and we have listed, so these are the carrying values per our books, all right, so at cost. And then we have fair market values at the end of the year and fair market values at the beginning of the year. So beginning of the year, we didn't have anything other than cash, right? That's what was contributed to the trust. And then at the end of the year, these are the values for each of the assets, all right? So we've listed those there. Now with the investments in corporate stock and bonds, you notice it does say attach in a statement. That's very important, right? So for charitable trusts, the split interest trusts, and if you're doing private foundation returns, they want you to list out each individual investment, right, by name with specificity. They don't want you to just clump it all into publicly traded stocks. So you would never just put publicly traded stocks, add them all up, and put a total number there. You should be listing out each and every stock and bond investment that you have. All right. Now in the liability section. So Most often, trusts will not really have a liabilities, but with net income CRUTs, you almost certainly will if you make those payables after year end. So notice we've got a line item here for Unitrust payable. And that's because we've calculated the amount of Unitrust payment that should be made to the beneficiary. So we know what it is, but we haven't been able to pay it out until after the close of the year. So it is a liability as of our books on December 31st. So how do we figure out how much is the distribution payable to the beneficiary? So we've done a trust accounting reconciliation, right? So what are our actual kind of cash in results here? Cash in, cash out. We've got our interest, the investment income, and our trustee fees, legal fees, accounting fees. So for our trust accounting income, in accordance with how we're supposed to do it under the trust agreement, we're including the interest, the dividends, but we are not including capital gains, right? So capital gains are just going to be allocated to principal from a trust accounting income perspective. And then on the disbursement side, we're allocating 1/2 to income, 1/2 to principal. So 1/2 of the trustee fees we're allocating to income, 1/2 of legal fees, and 1/2 accounting fees. That's typically what you see under a lot of agreements, and under a lot of state statutes will have that kind of allocation mechanism. So the net trust accounting income, fiduciary accounting income here is $35,113, right? Now, $35,113, that is really important because now we can finally check, well, what's the lesser of the two amounts? So we remember that the Unitrust annuity percentage 6%, $60,000. The prorated amount is $54,904. So the lesser of this versus the net income of the trust, $35,113. That's the amount that's going to Adam. So that's the amount that Adam gets. He doesn't get that larger $54,000 number. All right. So the Unitrust payable amount to Adam is $35,113, and so that's effectively why it's there on the books at the end of the year. So that amount will get paid out in January, February 2023, let's say, and then at the end of the next year they'll have a new amount, right? So they'll figure out what trust accounting income is next year, and then they'll have a new Unitrust payable amount. Now, trust principal and undistributed income amounts, we'll come back to this a little later. But effectively here, what you're going to see when we look at the distribution schedule is because the amount of the distribution was capped, right, is the lesser of the two amounts, we're going to have undistributed income and capital gains that roll forward to future years, right? And so there is going to be an undistributed capital gain carryover that could maybe get distributed to Adam, right? It just depends on how high the trust accounting income is in subsequent years, but also not likely, honestly. And that's because, again, the net income limitation is going to prevent trustees from being able to distribute principal. So all this really is added to principal, but we do have to separately track it in the event that it could potentially be distributed. All right, so let's have a look at the next sections. We've got Part 5, charitable remainder annuity trust information. So we don't have a CRAT here, right? We have a CRUT. We have a Unitrust. So we can leave Part 5 blank. The charitable remainder Unitrust information, we do want to complete this, right? So question number 1 is asking us, is the CRUT a net income charitable remainder Unitrust? And the answer is yes, right? So we do have a net income CRUT here. So we are answering yes for question 1. Now question 2 is asking, is this a net income CRUT with a makeup provision? And this case, no, right? This is the kind of, if you want to call it a standard net income CRUT. The net income CRUT with a makeup provision is a little different, right? That is a situation which effectively allows you in future years, when your income is higher, to kind of make up for shortfalls in prior years. So in this example, if this was a net income CRUT, Adam would have his $35,113, but the difference between this and that $54,000 number, that piece would kind of get rolled forward, and in a future year, he might be able to get that additional money. In a net income CRUT that has no makeup provision, that's not possible. We just look at the net income for the current period, and then that's it. So, question 4A, we have the Unitrust fixed percentage is 6%. All right, so it's 6%. We are indicating it's a short year return, and that's important because, again, the proration issue, right? So the 6% Unitrust amount on the fair market value of the assets for a short period, it's got to be prorated. You wouldn't use the full $60,000. But moving on to 5A, right? In the CRUT, in a standard CRUT, you can skip 5A through 6B. But in our case, we can't because we have a net income CRUT. So we've got to do a little more work here. So 5A, asking us for a trust accounting income, $35,113, and then it's asking us to enter the smaller of those two numbers, right? Because we have a net income CRUT. It's the lesser of net income or that Unitrust percentage amount. So the required Unitrust distribution amount for 2022 is going to be this lower number, the $35,113. So questions 10 and 11, no, we didn't change the method of valuing FMV for the assets, and no contributions received, no additional contributions received during 2022. We just had the initial funding of the trust, and then that was it. All right, for statements regarding activities, this is the provision covering self-dealing. Right, so Section 508E, the governing instrument and also local law should prohibit you from engaging in self-dealing with respect to this trust. Right, now Part 8, statement regarding activities for which 4720 might be required. This is the excise taxes that could apply if you have any kind of self-dealing transaction. So, as we highlighted on the slides, often it is the case that you will be answering yes to question 1A4, right? So compensation to or pay or reimburse expenses of a disqualified person, normally yes, right? So you answer yes because it's a payment to a trustee. Trustees count as disqualified persons. But then we also meet the exception in line 1B, right? If you answer yes to any of these, did any of the acts fail to qualify under the exceptions? And the answer is no, right? We did qualify for the exceptions because the payment amount was reasonable and it was necessary in furtherance of running this charitable remainder trust. Now, the rest of the questions, obviously, read through these carefully, make sure that they do or do not apply. One big one to be careful of is excess business holdings. That often happens quite frequently when trusts are funded with things other than cash, so closely held stock or partnership interests or something like that. Other things to be mindful of at the bottom here for section 664 trusts, so these are charitable remainder trusts. Do we have any UBI during the year? If so, if you have unrelated business taxable income, tax-exempt entities like these charitable trusts or private foundations, other kind of nonprofits, might have to pay some excise tax on this UBTI. In our case, no. We just had investments in publicly traded stocks, so we can leave. Well, we know that's an answer to no for that question. So Section A applies to all trusts, right? So answer or check these boxes if they are applicable, but in our case, no, right? We didn't have any interest expire during the year or prior to the year. We don't have a charitable lead trust, nor do we have a pooled income fund, so we can leave that blank. We do have to complete Section D because we have a CRT here, right? So line 10, right, we don't have an annuity or a unit trust whose charitable interests involve only cemeteries or war veterans posts. We're not making an election under these sections to treat income generated from property distributions as of the last of the year. We only distributed cash, so we didn't even have property to distribute for this reason. We are not making an election under this reg because we don't have any CFCs. It is an initial return, so we are going to check yes and then attach a copy of the trust agreement. It was not modified during the year, right? And then questions 15A and B can be blank because this is not a final year return. So we'll just leave those off. And then question 16 for FBAR filings, we didn't have any interest in foreign bank accounts, so we can go ahead and leave those blank as well. All right, so into Schedule A for the distributions information. So on this schedule, we track how income is categorized between ordinary, capital gain, non-taxable, how it's distributed to the beneficiaries, and then who are the donors of the trust. So the Part 1 accumulation schedule here and again, this is for Section 664 trust, so charitable remainder trust. We first pull the line 1 numbers from page 2 of the 5227. So it's asking us enter the amounts from Part 2, line 3. So if we go back up to Part 2, the schedule of distributable income, remember how we calculated these after allocating the deductions. So we have our total distributable income available in the ordinary category, in the capital gain category, and so those numbers get reported here in Part 1. So we've got the $34,476 in ordinary income, the $25,049 in capital, and then the total amount of distributions that were paid to Adam during the year. Now, we say during the year and that it had to be paid out during 2022, but because this is a net income CRUT, we can make the payment after the end of the year. But $35,113 is what's got to be paid out to him. So now we have to figure out how we allocate this $35,113 across the various income groups, right? So you can do this with an Excel workbook. So we look at our Excel workbook down here. The total Unitrust distribution, again, is $35,113. And if we keep in mind the ordering rules, right, we have to distribute out all the ordinary income first, and then we can move on to capital gains, and then we can move on to non-taxable, and then principal. And then within the ordinary income category, we want to distribute out those items that have the higher tax rates to start with. So $35,113 is what we have available. So that covers all of the interest income, right? It eats away at all the non-qualified dividend income, $87.64. And then it eats away at all the qualified dividend income as well. So because the $35,113 is higher than this total, we just know that, okay, well, all of this ordinary income is being distributed out to Adam. And then now, what's the difference being allocated to? Well, we still have $25,489 of capital gains that can be allocated to Adam. So we've got our $34,476, but the total payment going to him is $35,113. So the difference is $637. So $637 of short-term capital gains is going to be distributed to Adam, and that comprises, the total $35,113 of ordinary and short-term. So that's how we arrive at, well, okay, we know $35,113 has to be paid out to him, and what's going to be the breakdown amongst these general categories. So, going back to the accumulation schedule, we pull the full $34,476 out, and then $637 of capital gain is allocated, which means a remaining undistributed income in the capital gain bucket of $24,852. So now down to the distribution schedule, we've got Adam's information here, Adam Smith, his social security number, the Unitrust percentage, and then we allocate, as we did up here, amongst the ordinary and the capital gain baskets. So we have his $34,476, the short-term amount of $637. We didn't have any long-term, there was no distribution in non-taxable income, and then no principal distribution, right? And again, that would be kind of impossible, right? Because we have a net income CRUT, so we can't have any corpus distributions, unlike we can with just your regular CRUT. So for a regular charitable remainder Unitrust, you often very likely have principal coming out in the Unitrust distribution. So we total all the columns together. All of this comprises net investment income, right? We're all dealing with post-2012 types of investment income. And then on line 4, it's asking us just as kind of a check figure here, right? If the line 3 total in column I, so that's this one. If that does not match Part 5, line 1B for a CRUT, or Part 6, line 7 for a CRUT, check here and attach an explanation. So what are they getting at there? Well, if we go back to Part 6, line 7, all right, so Part 6, line 7 is the required Unitrust distribution for 2022. So that matches. It's $35,113. So what they're after there is they just want us to be able, they want us to make it easy to trace, okay, this is the amount of property that was distributed. What are the components of it, right? You need to make sure that all of these add up to the total, because otherwise, if there's a variance there, well, we don't know if there is corpus in there or there's some types of non-taxable income. It should all add up. All right. So down to the Part 5 for assets and donor information. So this section is completed for charitable remainder trust or lead trust. It is the initial return, right? So we are checking yes for initial return, and then we complete this schedule below. So John was the donor to contribute to the assets, contribute the assets to the trust. He donated cash. The fair market value of that donation was $1 million, and he did so on January 31st, 2022. Now, last question here. For CRTs, if this is the final year, was an early termination agreement signed? We have non-applicable because this is not the final year, right? And then lastly, what I like to do is just attach a statement explaining the Unitrust amount issue, right? So under the regs, the trust is making this Unitrust payment after the close of the year, and it's being made before the filing of this form. So, if the IRS ever looks at it, or they, if it's examined by anybody else and they're trying to figure out, well, the payment's not being made until after the year, what are you doing? We thoroughly explain what it is we're doing and why it's permitted under the tax code. So we haven't done anything to violate these rules. All right, so that covers it. Oh, no, sorry, one last thing to do. Look at the K-1. So the K-1, right? The K-1, very, very important to go out to the beneficiary. So the 5227 does not have its own version of the K-1. We just use the one from the 1041. So we've got the trust, EIN, name of the trust, fiduciary information, and then information on the beneficiary and the beneficiary's tax ID number. Now, the important parts are, again, up here in the income allocations, right? So remember, from Adam's perspective, he's just going to get a check for $35,000. He needs to know, per the K-1, what is the makeup of that amount. And so this will help him prepare his tax return and report everything as it should on his 1040. So we go back to our income allocations here, and we can see how we separated all these out. So after we allocated the deductions and we distribute everything out here per the Schedule A, we can see that the interest should be $7,314. So we've done so here on line 1. And then if we look at the dividend amounts, the total of these dividends is $27,162, and the qualified portion is the $18K. So we have $27,162 in total ordinary dividend. Portion that's qualified is $18,398. And then lastly, we have that short-term capital gain piece that went out to Adam of $637. All right. Okay, so that does finalize everything. We have covered all the pieces. I hope that was helpful. If you have any questions, feel free to leave a comment below, and I look forward to seeing you again on the next video. Thank you.